All right, let's go into chart selection. This is really important. This will be the third step after you do the basic scanning, which will be the 20% above in the pre-market, and volume over 100K, and minimum price for the stock price will be $2. And after you get the tickers, you want to go ahead and check out the market cap and the float to see if they actually fits the criteria to fit into the most frequent market cap zones that you trade for small caps. If it's over 1 billion, then you can get rid of that chart. But after they qualify for the ideal float and market cap zones, then you want to go ahead and look at the historical chart. Now, right here, this is the chart you're going to see after the first two steps. So first one, it will be individual resistance chart. This chart is going to be really fresh. Not much volume being traded other than one day trades mass amount of volume, then everybody moves on from that. No consistent downtrending, just pretty much a flat line with individual candles popping with massive volume. And every probably 2 to 3 months, the more often the better for the resistance. So second one will be the consistent resistance chart. This one is pretty much the ticker trades 500K shares above every single day. And the consistent resistance, the consolidation means the price cannot fluctuate more than 20% of the stock price for that consolidation. So if the consistent resistance consolidation is fluctuating more than 20% of the stock price, then the stock becomes not tradable. And then number three, we have consistently downtrending chart. This is when the ticker starts to slowly downtrend, probably 1 or 2% every single day in the last couple of months. The longer, the more aggressive the first green day is going to be. And normally start with a gap up short, and that's where it squeezes a lot of people. So consistently downtrending chart is pretty easy to recognize. And now, if they only been consistently downtrending for a week, it does not consider as a consistently downtrending chart. Minimum time length has to be over 1 month. Then you have the messy chart. The messy chart is pretty much the chart that it goes up and down without any type of consolidation, without any type of individual resistance. It's pretty much, you can't really get where the resistance is. There's no heavy volume, there's no light volume, there's only light volume, and the chart was going parabolic, come back down, parabolic, coming back down, and no time length at all. So when the chart trades really low volume, that means the stock has a lot of neutralized area. When there's a lot of neutralized area, you cannot distinguish where the buyers and where the seller is, and they're not concentrated in one price level. That means you cannot read the resistance or the support, and that makes it really difficult to trade. So messy chart is also difficult to trade. You can see a little bit typo in there. And number five is the barcode charts. Now, barcode charts typically involves with buyouts. If a company decides to buy another company, then the stock pops up 100% and trades at that, $3.50 exact level, and you bounce left up and down for probably 1 cent. So whenever you see this type of buyout chart, a lot of people are thinking, oh, it's a gap up short. You have to actually look at the news. Now, sometimes you don't even have to look at the news. You will see it's a barcode chart. If the chart gaps up straight up in one candle and it's consolidating at a very tight range, then if you zoom in, it looks like pretty much a barcode because it's consolidating at a really tight range. These type of charts basically are not tradable. Therefore, the algos, sometimes they trade by the spread, but it's definitely not for the retails. So trading these by scalping it with massive size does not work. Then you have the reverse split chart. A reverse split, as I mentioned, if you see a reverse split chart, as soon as they do a reverse split, they pretty much cancel all of the resistance in history. And this is what small caps they tend to do, is they first of all, they'll pump up the chart, then get the buyers in, and they will do an offering, trap the buyers in there, and buyers slowly get desperate and will start to sell. Then the chart goes below $1. It does not fit the Nasdaq requirement. Then they will do a reverse split. They will change the flow and market cap completely. So when they change the flow and market cap completely, that means it's a different stock. It's pretty much a fresh, different stock. Then makes all the heavy resistance in history does not count anymore. So this is also very important. A lot of people are using the historical resistance for the reverse split charts, and then they tend to make a mistake because resistance is not actually resistance anymore. So that nobody can trap a lot of shorts, especially on the first screen day. And I've personally made tons of mistakes on those reverse split charts. So not recommended to short on the first screen day using the historical resistance. And also after reverse split, they normally reduce it down to either a low flow or micro flow. If it gets to the micro flow area, then don't trade the reverse split if the stock is on micro flow. And when the chart keeps doing reverse split again and again and again, if you do it once every year, it looks okay. But if you do it 5 times, 7 times, even more throughout the year, then the chart will likely look pretty ridiculous. And when you look at the historical chart after the adjusted reverse split, then you will see the stock went to $1 million before. But it never went to the $1 million because it's the adjustment after the reverse split.